So we are just basically looking at the recap of the income statement. This is what we would have done last week, right? So we are back at this. We have a question to correct. So we actually have a recap. We're looking at the question and we are moving on to our next topic, which will be the adjustments to the financial statements. So I just asked you guys if you all were able to complete it. Yes. So during this session, I will be correcting the question and we will be starting our lesson 2, which deals with the adjustments to the financial statements. All right, so if you all have any concerns or questions during this segment, you all are free to message me via the chat. All right, so we are looking at the question here now. So this what we see here on the screen is basically just the format of the income statement. We looked at this last week. Remember, we could always go back to the recordings via YouTube, look at last week's session. If you all are new, please go back to the previous recording where you'll be able to get a full explanation of the income statement. And of course, we also looked at the balance sheet. All right, so we also have the format of the balance sheet. So with that being said, the question that I had for you guys to do was a simple question with no adjustments. This was just simply preparing a trial balance on what we are seeing here now on the screen for the period April 30th, 2019. We had a list of items here and the instructions were to prepare trial balance for Woodruff Enterprise. The amount of capital must be included, all right? And part B was to prepare the income statement and statement of financial position for Woodruff Enterprises. Okay, so just for you all to note that during this session, I am going to be correcting this question. Please, you all can input your answers via the chat. As you know, I'm making note of participation because all this is going to assess you all for the new term, okay? Because when the new term starts, yes, I will be recapping, but not at the slow pace. We will be recapping, but at a faster pace, right? We want to finish off the syllabus for just in time for the CSAC PoA exam, which should be around May, June tentatively, all right? So we have a lot, so let's just get started. So we had to prepare the trial balance firstly, okay? So when you would have looked at the Form 4 syllabus, I'm sure you would have had exposure to the trial balance, okay? So this trial balance, we have to draft up, okay? So I'm going to share my screen of how this trial balance should really look. All right, so just by some feedback, by raise of hands, those who are able to see the screen, use an Excel sheet. Yeah. Woodruff Enterprises trial balance as at April 30th, 2019. So again, you all could obviously pause the question, take a picture of the question because we are looking at the answers here now. Okay. So building. So this is a good revision for those who still have problems identifying what items should be debited, what items should be credited. This is an excellent example and a way to just recap all that you should know at this point in time in the Form 5 syllabus. So buildings. Buildings had an amount of 100,000, right? So buildings, does it have a debit balance? Is it a credit balance? Where would you put it? Okay, so I'm seeing Sahara Akila saying debit. That is correct. So we are debiting the buildings account. And you all know where we got this figure from? It would have been from a ledger. We would have drafted out some ledger accounts for all these balances here, all these different accounts. We would have created ledger accounts for these. And the trial balance is just a final step to just ensure the accuracy of all that we would have posted in our ledgers. Yes, correct, the general ledger. Sahara, the general ledger. So we would have done all this in the ledger accounts, which is, you know, the form 4 syllabus. You all should be accustomed to this by now. So buildings, we know it have a debit balance. What about sales? Sales have a debit or credit balance. Okay, so I'm seeing some correct answers here. Credit. And the amount that we had for sales in the question was 226,843. Good. All right, if you have any questions, let me know. Opening stock. So identifying now stock here in the trial balance, we note that it is an opening stock. We have two types of stock. The other is opening and closing. Opening stock goes in trial balance, whereas closing stock goes outside the trial balance. All right, and that is going to be making the adjustments to the income statement, to the balance sheet as well. So opening stock goes into the trial balance. As a debit item or credit item? Debit, correct. Opening stock have a debit balance. Let's look at the next item, commission received. So commission received, well, I know you all are asking why debit. We know stock is an asset. It's a current asset, that is. So we know, you remember the PoA Bible I was telling you all about the first class? Know what, when assets, what balance do they usually carry? What balance does liabilities usually carry? Usually, you guys, I say usually, that's a key word. Not all the time, you know, your assets will always have a debit balance. If assets decrease, on the other hand, it will carry a credit balance. When assets are decreasing, we credit it. But in this case, we're just accounting for the asset. Normal asset accounts have debit balances. So I hope that answers the questions in the chat at this moment. Let's look at the next item, commission received. So commission is a type of what? What is commission? It's a revenue. Okay, so I'm seeing some of the answers being a revenue, right? We would have made some kind of sale and we got some money out of it, right? So it could be a little, also sell more than 50 items, you'll get a little extra bonus, like a tip. Yes, April, that's a good answer. It's like a tip, right? But it could be a little bit more than a tip. It's a bonus. It's a what you work for, what you sold throughout the period, we're going to get some money out of it. And commission, as we say, is a revenue. It's like a revenue. And all revenue accounts have credit balances. So hence, in the trial balance, our revenue account will be credited. Good. Let's look at the next item, cash on hand. Cash on hand. Is that an asset account, a liability account? Okay, so I'm seeing it's an asset account. Yes, cash is an asset, and all asset accounts usually have a debit balance. So that's why we will put the 6237 on the debit side. The next item is purchases. Purchases is when we bring goods into the business, right? So purchases, yes, you all are correct. It will be debited. Purchases have a debit balance. Motor vehicle. Motor vehicle is what? An asset. Asset accounts have a debit balance. So we go to the 90,000 being on the debit side. And yes, specifically a fixed asset. This motor vehicle is a fixed asset. Let's look at accounts payable. We know accounts payable to be a fancy word for what? What is accounts payable? What is accounts payable? Okay, so yes, it's a current liability. It's also called creditors. So accounts payable, which is a liability, all your liability accounts have credit balances. Good. So you all are getting this correct so far. I'm seeing your chat. I'm seeing your responses. Excellent. Let's move on to carriage inwards. Carriage inwards is when we transport goods out of the business or in the business. And I know you all have your common sense, your caps on. So it's coming in the business. So this is what? Debit or credit? It's a debit, right? You would have purchased goods and you will want to go, so how are you going to reach in your business? You will have to create some type of transportation to get the goods in the business. So carriage inwards will have a debit balance. Good. Advertising expenses. Advertising is an expense and very good. Sahara, Brittany, Carissa, I'm seeing you guys giving me the answer being a debit balance for advertising. So advertising, which is an expense, all expense accounts have debit balances. Equipment. Equipment is another asset. Asset accounts have debit balances. Now we're going on to discount allowed. So question, discount allowed is what exactly? So I'm getting the answer, but what is it? What is a discount allowed? Yes, we know it's an expense. Yes. Celine, good. We know, yes, all expenses accounts are debited. It is a discount given to the customer. Good. So with a discount allowed, right, we are allowing a customer to get a lower price for a good. So they would have bought something from the business and we know, hey, since you are a loyal customer, I'm going to give you a 5% discount. Now the business should be selling it at a profit, but instead they sold it at a loss because they are decreasing the price of the good for the customer. So it's an expense. So hence, yes, it is a debit balance. Accounts receivable. Now we know another term for accounts receivable being debtors, right? So debtors have debit balances. It is an asset account, right? Return outwards, also called purchases returns. So what do we do here? Is return outwards a debit or credit, and why? So I'm getting the answers correct, but I'm sure you're saying return outwards is coming out the business, so it'll be credited. Yes, you all are correct. Right? If you all were thinking that, you all are also correct by thinking that it's where we would have purchased goods from, let's say, a supplier. Let's say the good was faulty, or we just it's not suitable again for the business. They want to return the good. So it's going to leave the business, hence the reason we are going to credit it. We have carriage outwards. Carriage outwards is going to be debited or credited. Carriage outwards. So we can't use the common sense here. Because yes, you're seeing carriage outwards, so it's leaving the business, but carriage outwards is where we have to incur this expense to get the goods to the customer. So carriage outwards is considered to be an expense to the business, and all expense accounts have debit balances. Then we have discount received. Let me hear some answers here. Discount received, debit or credit? Okay, good. So you all, I'm seeing all the answers being credit balances. Reason being, it is considered to be a revenue account. We receive this discount from our suppliers, hence it will be credited. It is a revenue. It is like a revenue, right? We have salaries. Salaries is a debit item. It is not, it is an expense because we have to pay our workers, right? So we debit salaries. What about bank overdraft? Is a liability account. Good. Is a current liability, yes. And as a result, it will have a credit balance. We have miscellaneous expenses. Well, here in the term expenses, we know all expense accounts have debit balances. Mortgage, we have to pay for mortgage, another expense. So what do we do for mortgage? So you see how I just tie up you guys there, right? Yes, I said it's an expense, but we have to pay this over a long period of time. Long-term liabilities. So mortgages have a credit balance. So good. I see that even though I try to tie you all up, I see your answers coming through the chat, but you were able to identify it quicker by saying it is a liability. We have to pay this, but for probably a short period of time or a long period of time, depending on how long this mortgage is to be paid. Then we have return inwards. Return inwards, also called sales return, whereby customers we would have sold goods to the customers. They come and return it inside the business. So we are getting it back. It will be debited. Drawings. So drawings is, just remind me, what is drawings again? Right, taking out money for personal use. Yes, Carissa, that is correct. Good. So money spent by the owner for personal use. And because it is coming, it is like, is drawings an expense, you guys? It is not being used for the business. Because drawings is for personal use, we do not and will never put drawings in the profit and loss account. It is not an expense. We're taking out money for personal use. I could go and buy food with this money. Is it going to, yes, it might impact the business because it's coming rent or electricity or telephone bill, right? So drawings will be debited. Good. So at this stage, we would have accounted for all the debits and all the credits. And now to solve for capital, which is what the question is stating, what is the capital? We have to find the total assets and our total debits and our total credits and minus it. That is to get your capital figure. So total assets, let me just drag this down. If you could see where my cursor is, I'm getting 460,866 as a total debits, right? And my total credits, 310,075. We find the difference and we get 150,791, which I'm seeing here on the chat. Very good, you guys. Aliyah, Celine, very good. And now we just total everything. And we will get 460 on your debit side, and on your credit side, 460,866. So debit and credit must equal to now feel good about ourselves, one, because we would have balanced off the trial balance. That's the first stage. Now it's onto a bigger stage here now, which is leading us into the income statement and then the balance sheet. So we have to prepare the trial balance, or a trial balance will be presented to you guys to actually now go ahead and do the income statement and the balance sheet. All right, so we are moving on to part B. I know it's a lot, but if I'm going a little too fast, y'all let me know. I know some of y'all are still new to this. So I just have here the format, which you know you all should get by now, because I know you all would have been introduced to this in the Form 4 days, whether you are a repeater, whether you would have done this before the end of the exam, but this here should now be, you know, in your heads by now. You should know this to a T. It should be at the back of your head. You don't need to go at the textbook or the notebook to get the format. This is your standard format for the income statement and the balance sheet, also called the statement of financial position. All right, so I just laid it out on the screen, and all we do right now is to plug in our figures. All right, because after this, I'm just giving you all a heads up. We are going to be looking at a question afterwards, where you all are going to do it. It's an in-class question. This was an at-home question. We are going to do an in-class question, and we will see how much we can actually correct, right? Because we are looking at the adjustments next rounds. So you want your mark? Make sure you have your headings. So Woodruff Enterprises, what are we preparing will be in the second line, third line for the year ended April 30th, 2019. I then have my $3 signs, in other words, my 3 columns. That's giving you 1 mark already in that exam. So we're now plugging in the figures here. So we're looking at the sales. How much was our sales figure? It was from the trial balance. So we're not going back to the question. We are looking at the trial balance, $226,843. And you all want to know a little secret, a little way to at least try to balance, at least ensuring that you account for everything correctly. You didn't miss out anything, because I mean, we have a list of items. Chances are, if you're in an exam, I mean, everybody goes through that anxiety, that pressure, that, you know, fear sometimes. But just to calm your nerves, what I was always told to do is, whenever you account for a transaction, tick it off. You will have prepared a trial balance correctly and was able to balance. Tick off your sales figure. So that means we would have accounted for it. So in case we don't balance and we don't see a sales figure, then we probably say, okay, we forgot to include the sales. So tick off, put a mark by sales, knowing that you would have accounted for it already. right? So that's a little secret that I'm sharing with you guys. And I have many other secrets moving forward to ace that exam, get those distinctions in PoA. And, you know, obviously, I show you, your other teachers will show you ways of getting those distinctions. All right, so before I move on, I would like to know if you were able to balance it. I know it was a homework question. I'm seeing some good answers here. So we will go through it, yes, one at a time. It's just to start up. For the new term, you will just be pacing with past papers and notes, right? So we are going to account now for a second item in the income statement, which is our return inwards. Our return inwards figure, we have to less it. So we less our return inwards. Okay. What do we do from here? We less them. So we get our net sales figure of 223,193. You all got that? So yes, Trent, I'm seeing your answer. Good. Great. The rest of you guys, excellent. So we go to the other segment here of the trading account, which is your opening inventory, or also called your opening stock. And that will be found in the trial balance. And we saw the figure to be $14,500. Then we had a purchases figure. So again, you're ticking off when your account, so far we accounted for 1, 2, 3 items. Tick them off in the trial balance to know that you accounted for it. So purchases was 44,000. Carriage in was your next item. And what are we doing with the carriage in? We are adding it. Yes, that's how much was it? It was 44,000. Just making sure. Carriage 84. Yes, 84,000. So I'm just basically, see where I did sales. I could just put a little highlight there. I just dealt with opening stock. I could put a little highlight there. I now dealt with purchases. I could put a little highlight. Now looking at opening stock, which is, just saw it. Besides, I don't know why I don't wear my glasses. I'm looking for the opening stock. You're seeing it? Yes. Right, so I already clicked it already, good. So we can move on from there, and we accounted for the carriage. Carriage inwards. Right, so this is what I want you all to do. Obviously, you all won't have a highlight in the exam, but you all will at least have a pencil. So just put a little tick sign on these items. This is what I mean by ticking them off. All right, so we're using this entire this answer here to format our income statement. So we're moving on. Gross profit figure will be equal to now be the 52,400. 44,000 plus the 8,400. And then now the format is telling us we must less return outwards. And return outwards is equal to $4,500. So you'll see how I'm laying it out. This will be, when we less our return outwards, your net purchases will then be 47,900. I know you guys want to come online and chat and let me hear your responses, but as soon as we are through with these sessions here, you all will get opportunity to express your love for accounts. I'll hear your voices, all right? Because I know there's a lot of you guys now. We just want to manage these settings here for just my voice, but I will be including your names in the chat when I'm getting your answers. So yes, Trent, that answer, 47,000, you got it. Great. So how do we get our cost of goods for sale figure? We need to add the 14,500 and the 47,900. And we should get 62,400. Now, we left our closing stock. Closing stock figure. How did I know my closing stock figure was 18,550? Well, going back to the question, so this will not be in trial balance. We said stock, closing stock that is, will be outside of the trial balance. So just going back to the question, look, it's across here. I'm just going to bold it, highlight it. Look, our closing stock is 18,550. So please note, even though you're in the exam and you're like, where's closing stock? Where's closing stock? It will always be outside of the question, outside of the trial balance. All right. So I'm going back to the Excel sheet and we see the 18,550. Let's say we get our cost of goods sold being 43,850. Very good, Adriana. I'm seeing your answer. Good. So gross profit will now be the difference between our net sales and our cost of goods sold. Net sales minus our cost of goods sold, 179,343. Good. So, but that's not it. That's not all to the income statement. We must remember to include whatever additional incomes we would have received throughout that period. And in the question, well, in our answer for the trial balance, we had commission received. Commission received is our income. It will add to our gross profit. And as a result, we need to include it inside. As well as discount received, which is another revenue account, we add it. So that should tell us our total income of 190,143 was earned by Woodruff Enterprises. That is our total gross income or gross profit. But I'm so sure Woodruff would have incurred some expenses, yes. And now we are in the profit and loss section, also called our operating expenses. All right. We're going to place all our answers in the second column. And if there were any workings, like when we go to our next topic with adjustments, you would have our workings in the first column. We place all the answers in the second column. We place the totals then in the third. And you always see how I'm doing that with other questions. So advertising expenses, it was just one figure. So we're just going to put it in 84.85. Then we had discount allowed. We established being an expense, 75.60. Carriage offers was another expense. So you're ticking it off, right? Just remember, tick it off, because I will intentionally not balance and you'll have to tell me where and why did I not balance. So please tick off your answers, tick off the items that you have accounted for. Carriage outwards, 27.30. Salaries was the other expense. It should be 23,700. And our next expense, miscellaneous. Was that all the expenses? So this is a question that I really need to ask you guys. Was that all the expenses or there was some more expenses? Double check, make sure that we are accounted for all. Let me just make sure So we look at the commission received already. We looked at advertising expense. We looked at discount allowed. We looked at the carriage outwards. We look at discount received, salaries. Well, what bank overdraft? Do we have to put it in? We say this is a liability. Good. So we do not put it in. Miscellaneous expense, we accounted for that. Mortgage is a liability. You see this on the credit side already. We looked at return inwards. We established drawings is not the expense. So yeah, we basically did account for all our expenses. So 5 expenses. Good. So our total of these 5 expenses came up to be 57,575. So what's now our net profit or net loss? We simply find the difference between the 190, which is our total income, minus our total expenses, which will give us our net profit, 132,568. Hands up for those who were able to get up to here correctly and honestly. Good. Excellent. So for those who weren't able to get it, you are seeing where you all went wrong, what little mistake you all would have made. I'm sure it's a little mistake, probably the addition, the subtraction, right? So note your errors. So when we go to the next one, you're all able to get everything correct. So we can move to the balance sheet, the statement of financial position. And let's just say well, we're not going to get anything wrong in the exam. I am declaring that. You are not getting anything wrong at the exam. But in case you all just remember, you want your mark for the headings. I'm going to keep saying it. You see your headings? You're going to get 1 mark already. Right? Examiners will not double penalize you guys if you all, let's say you made an error quite up here. And from there, your whole thing end up being wrong. You do not get double penalized, right? Because by looking at, how they mark the papers, double penalizing, you just get penalized once. But once you account for your items correctly moving forward, you get your marks for every item. All right. If your addition was wrong, you might get a 1/2 mark off, a 1 mark off, but it will not show you off for the rest of the question. All right. So that's a good thing. Just ensure that your format is correct. All right. So when we look at, so Adrian is asking, why did I put the expenses in the second column? Simply, there were no adjustments to the expenses. Because if there were, you put them in the first column and you put your answers in the second column and your total in the third. But because it's a straightforward question, we just place it in the second column. All right. Yeah. So let's move on. Buildings. So if you had placed it in the first column, it will not be wrong. No, Trent, if you place it all here, it will not be wrong. So don't be scared if you feel that you place this in the first column and then you put the total quite across here. Remember, at the end of the day, you want to look at presentation, right? So presentation is important. You want to become future accountants. You want to be able to present your findings, your whole statements neatly, so other users can view your statements. So go into the balance sheet. So whatever was not highlighted is what you will put in now in the balance sheet, right? So we're going, starting, buildings. Buildings is our first item. Cost price of our buildings is 100,000. Was there any accumulated depreciation? And I'm sure you all would have done depreciation in Form 4. If not, you all will have the opportunity in the next session and moving forward, we're going to be looking at depreciation, accounting for bad debts, accounting for accruals, prepayments, all these different adjustments will be accounted for when we are preparing the statement of financial position. So accumulated depreciation, just in a nutshell, is our total depreciation that we would have incurred throughout the period. Because this question is so straightforward, there was none, luckily. So we just put a 0. Not all the time will always be 0, you guys. And we just minus it. So our cost price minus our cumulative depreciation will give us our net book value, also called NBV, net book value. Okay. Next item that we have is equipments. Equipment had a cost price of 110. There was no depreciation for the year for this equipment. So our net book value is 110. We minus it. Motor vehicle is our next item. Our cost price is 90,000. There was no accumulated depreciation. So our net book value, when you minus it, 90,000. So total of fixed assets. Let's just do this here together. I'm just going to total there. Right? We had a 0 as well over here. And our total on this side comes up to be 300,000. All right. We are not doing anything to this part here. This is just our calculation of our net book value. This is our figure that we are moving on with. So I want to just draw some better lines here. Just give me a second. Take out the double underline. Right? So we are through with our fixed asset section of the balance sheet. Now we are looking at our current assets section. And we see an inventory. Inventory is this the opening one or is this the closing inventory? This inventory that we are accounting for under current asset, is it opening or closing? Very good. It's a closing inventory. And the amount that we had was 18,550. Next figure is a debtors, also called account receivable, 22,140, and then we had a cash on hand, 62.37. We saw all that in the trial balance. So I hope you all know what you're doing. You're ticking them off over here, right? But I'm moving on. So we're going to total our current assets. Total of current assets equal 46,927. Just double checking. 46,927, correct. So when we get our current assets, we must less our current liabilities. And we looked at that last week in class through the PowerPoint, where to get our working capital, it is our current assets minus our current liability. Working capital, we need to find out what we needed to accommodate our day-to-day expenses. So we had accounts payable. Those are our supplies that we would have gotten some, let's say, goods from. So 19,158. Bank overdraft. We would have borrowed some money. So you may be asking yourself, but sometimes bank overdraft could be a long term. It depends on what the question is saying and the amount. If this was a large amount, then you know that it will not be a current, it will be a long term. Bank overdraft, do you all know what it is? A bank overdraft? Just plain and simple. This is where we would have taken out more money than what we actually have in our account or in the business, right? So we basically borrowed money from the bank. So we are owing the bank $5,974, which must be paid back in a short period of time, within a year. So that was our total current liabilities being $25,132. What we do with it now? Yes, April, that's correct. It's a loan, but not really a loan. Yes. What we're doing here now is that we have our current assets, we minus our current liabilities to get our working capital of $21,795. Good. So for those who got that, great. Good job. So we're going to get now our net assets. That's what the format is telling us. So to get our net assets, we total our current assets, total fixed assets, and our working capital. And we should get $321,795. And that is our balancing figure. So we need to continue and aim for that figure being, for capital employed, to $321,795. So this is where we actually now hold our breath, hoping that we balance. So we're going to start off with opening capital. We are under the finance by section. So opening capital, we would have calculated it in our, yes, trial balance. Look, our opening capital is here in green, $150,791. So you're bringing that figure across here, 150,791. We're adding our net profit, and where was our net profit figure? From our income statement, 132,568. We're bringing it in here, 132,568. We less our drawings, which is in our trial balance, 43,64, to get our closing capital, and we're placing it in our third column, 278,995. So you all should be getting the gist as how I am moving from one column to the next column just because of presentation. I don't want to put everything in one line. If you all do, it's not like you all will get the whole question wrong, but let us try to aim for those distinctions. I'm going to keep pounding it in you guys' head. We're going for those distinctions. Let us get presentation intact, right? So finance by is not completed. We have another part of the finance by section which deals with our long-term liabilities. And our long-term liability was our mortgage. And the mortgage figure from the question, we trial balance, $42,800. So holding our breath here now, 278,995 plus our 42,800 will give us 321,795, where we are seeing they are being equaled up here. We have one figure there. We have the same figure below here. So we know that we are correct. This is our final stage to know by preparing the income statement and the statement of financial position for Woodruff Enterprises. We know that we are correct when we balance through the balance sheet. Yes, so congratulations for all those who were able to get to this far with me with those answers. Congrats. For those who didn't, you all were maybe off. I'm seeing some of your answers. You're getting 300 something thousand, 280. You all were close. You all probably missed out a little calculation, but this is our first question that we are doing. So I'm betting you guys by the next question, you all will be able to get everything correct or close to everything correct. Okay. So let's move on from here. And I'm going to just pull up our second session for this evening, which is going to look at now the adjustment. So we looked at the basic parts. I just want to just complete that because I know we want to get to the advanced stage of accounts, and we're getting there slowly but surely. So we are moving to share the screen. Just letting us know, you guys. All right. Lesson 2. So we are looking now at the adjustments to the final accounts. So in this lesson, we are taking all that we would have learned just now in that question, and now we are applying it to now additional sort of information as we would see in, in those past papers, even in your exam. We have to be mindful that this is a question that always comes for exam. So you need to master it, all right? Okay, so again, everything will be on YouTube. So for those who need to just recap the first part of this session, please feel free to go ahead and view the session, okay? So we are still under section 5 of the syllabus, adjustments to final accounts. So here we are going to be learning accruals, which are amongst owing, prepayments, which are amongst paid in advance, depreciation, which is the loss in value of an asset due to wear and tear, passage of time, erosion, and depletion. We'll also be looking at bad debts. So we have some rules of how we're going to account for these different transactions. Okay, we have some rules that we need to understand, appreciate, as well as apply for the exam. So when we are looking at amounts owing, all amounts owing for the current period must be added to their respective accounts. So what does that mean? You, let's say, being a business owner, and let's say you have to pay rent every month to just occupy the space for your business. What's happening here is that when we pay this rent, there may be a month where we were unable to make payments. In other words, we owing for rent for that particular month or months. What we have to note is that whenever we are owing an expense, we have to add it to what we're supposed to be paying. And we will look at that in a question in a bit. I just want to give you all the idea of whenever we hear accruals, we have to add it to what we have to pay. Okay, so if it is making too much sense to you guys, just wait. Don't give up yet. We are going to look at the next few slides, which will add to that one point. Okay. The second rule is that whenever we prepay or we make any prepayments, we must deduct it from our account. So what is a prepayment? A prepayment is when we make some type of payment in advance. So I think rent is like a basic example to use. I am a business owner. I have to pay for rent. Just so happen that I'm paying every month $500. January, I'm paying $500. February, I'm paying $500. But let's say in March, I want to pay $1,500. So that means I would have paid for March, April, and May. And if we have to prepare this financial statement up to March, we cannot include April and May because it is not relating to the current period in which we are preparing our financial statement. So whenever we make a prepayment, we have to deduct it from the amount that we're supposed to be paying. All right? So that is another rule to just bear in mind. The third rule we have here is depreciation of fixed assets, which must be debited or entered as a loss on the profit and loss account. So there are two ways in which we can calculate depreciation. So please know depreciation is an expense, and we can actually calculate it in one of two ways. As a percentage of the cost price, which is going to be using the straight line method of depreciation, or we can use the reducing balance method where we have to get a net book value. Net book value is equal to your cost price minus your provision for depreciation. And I'll show you guys how to calculate all of this through a question. All right. So again, depreciation can be calculated in one of two ways, either using the straight line method, which is so basic. All you have to do is just find a percentage of the cost price. I bought a motor vehicle for $50,000 and it got depreciated because I used it for a year. I'm going to put like a 20% depreciation rate on it. 20% of the $50,000 will be my depreciation expense. But if I'm looking at the reducing balance method, I have to get the cost price. I have to calculate what I'm going to depreciate my vehicle for, whether it be every month or every year. I will depreciate it by $500, right? Because I'm using it. I will get my net book value. And depending on the amount of years that I have this vehicle for until I actually sell it, that is how we will be calculating our depreciation figure. So we will be seeing how to do that in another topic. In this chapter here, we're just going to account for it. All right, so we are looking at that in the next topic. So all that we are looking at right now is the matching principle. The slide we just looked talks about the matching principle, which states that all amounts relating to the current period must be included in the accounts, and all amounts not related to the current period must be excluded from the accounts. That deals with the matching principle. So we didn't pay rent for March, April, May. We're preparing our statement up to December. We have to include it. It must be included in the account. If the amount is not relating to the period in which we are preparing our accounts, it must be excluded, like what we see for prepayments. All right. So are you all okay with that? Just by, if you all have any questions, I'm going to stop here for a while. Take a little breather. Do you all have any questions? Please message on the chat if you do. I know you all will have questions, but when we get into the actual workings of how to make these adjustments, we will understand. I'm going to guarantee you all will understand how to make these different adjustments. All right? So we have here adjustments in the balance sheet. So we say we have closing stock, which is a current asset, accruals. Now, give me a second. The notes will be posted up April. in the YouTube channel, right? So accruals, which we have two types of accruals, which accruals means owing. Just remember that. Accruals means owing. But we have two types of owing. We have expenses owing and income owing. If expenses are owing in a business, it is a current liability. But let's just say income owing, like to us, the business, let's say rent received or interest received, we know that it is money that is coming into the business. So as a result, it will be considered a current asset. So income owing, this means income owing to the business. If income is being owed to the business, it is money that the business has. It is a current asset. And then we have prepayments, and we have prepaid expenses, and we have prepaid income. We have prepaid expenses and prepaid income. So I'm just going to highlight that. We're looking at prepayments, expenses prepaid, income prepaid. If we have income prepaid, it does not belong to the business until the next accounting period. So imagine you have to account for, let's say the first one, expenses prepaid. It is a current asset because a customer would have come and paid for, let's say, a few months subscription fees. Let's say they come to, we have a gym, and instead of they paying every month, they pay a subscription for the next 3 months. All right. So expenses prepaid, we are looking at it being a current asset. Whereas with income prepaid, if that customer comes and pay off their account, not the pay off their account, but they come and they make those 3 months of payments, we are owing this customer service, right? Because we are owing this customer service, because they paid for their gym fees, we are owing the customers a service. So I'm going to just repeat this once again, because I know if you are new to it or probably had some difficulties in the past, I'm just going to see how best I can clear up those trouble areas with regards to accruals and prepayments. So I'm just going back again with accruals. If expenses are owing, we are owing for rent because we didn't pay a certain month, it will be a current liability. We are owing for this rent. If income is owing, it is considered a current asset because it is income owing to us. So we get rent received from a tenant. A tenant comes and let's say they pay, or we get an interest received or some kind of discount received or commission received. If we get these types of income owing to us, we consider it to be a current asset. Prepayments can be expenses or it can be an income as well. If expenses are prepaid, it is a current asset because we paid more than what we're supposed to pay. As a result, we have it in the business. But if income is prepaid, where a customer comes and pay in advance for some type of service like gym fees for the next few months, because we are owing them that service of getting access to all the equipment in the gym, and they can work out, they could do their mountain climbing in the gym, all those different things, we can't just kick them out because they would have paid in advance. So prepayments is being paid in advance. Accruals is what we are owing. All right, so I hope that clears it up for you guys. When we get into a question, you will see exactly how to account for it. With regards to depreciation, which is recorded in the profit and loss account, it must be added to the provision for depreciation from the trial balance. So we're going to see this as well. Depreciation recorded in the profit and loss account, because we say depreciation is an expense, we must add it to the provision for depreciation from the trial balance. This will be posted as well. Okay, so we're going to see how to account for this particular rule as well with a question. We have net book value, which is the difference between, we said it in the previous slide, cost price minus your total provision for depreciation. That's your net book value. And then we have bad debts, which is you minus any new provision for bad debts from your debtors. So provision for bad debts being the expense, you will have to account for it now in the balance sheet. So all of this, we are going to elaborate here now on what am I talking about, right? Because I am going to show you all how we can account for these adjustments in the balance sheet. So we finished with accruals, with prepayments. Let us look at the bad debts. So first of all, what is a bad debt? We know bad debts are amounts that we are certain that we will not receive from a debtor. And as a result, they are written off as a loss to the business, right? So we know this. We should know this by now, all right? Bad debts, we are certain that we will not receive money from a debtor. So if you have to account for a provision for bad debt, so just in case this customer can't pay off their account, all right, just looking like a person who coming in this business so much time, we know they're not going to pay off their account. What can the business do? What can I do? I can't tell them, hey, you can't buy this, you know. I can't do that. What I can do is make a provision just in case they come and buy it, and we happen to know that they will be falling into some kind of debt so they can't pay it off. I am going to put aside some money just to accommodate this customer, because we know that chances are, if they can't pay off their account, we have this money set aside just in case. And I put it in inverted commas. Just in case they can't pay it off, provision for bad debts are being created. So I'm creating a provision for bad debts. You all okay so far? Right. I just want to see some thumbs up, or you all understand why we're creating a provision for bad debts. Because just in case we cannot get the money from our customers, I'm going to create a little piggy bank, wherever you call it. But it comes with a provision. I'm creating a little provision just in case they can't come and pay off their debt, just in case. So they are set aside out of profits to cover future possible debts. All right. The amount set aside is usually a percentage of the debtor's figure. So debtors are people who owe the business money. All right, I'm going to create, let's just say 50% of my debtors not going to pay me back. All right, I need to take 50% of these debtors and take it out from my profit just in case they can't pay me back. This provision represents amounts that we believe may be bad or uncertain. All right, so you know that this is a real life scenario, you guys, talking from experience here. So as you appreciate the notes and we see how to account for it in real life, in the real world out here, You know, you don't put all your eggs in one basket, right? We want to make sure that we have something as backup. This is what we're talking about here. So accounting entries for provision for bad debts. If you have to create a provision for bad debt for the first time, we need to know that because you know bad debt is an expense, we debit our profit and loss account. And what are we creating and going to record in the balance sheet is the provision for bad debts. That is going to be minus from our debtors figure because we had a debtor of $1,000. Debtor come and say, you know, I can't pay you back this money. All right, let me take out this provision for bad debt. So you minus whatever that amount is to get our true figure for our debtors. All right, so that is to create a provision for the first time, just in case they fall short of their payments. If you have to increase an existing provision for bad debts, in other words, all right, I reach, what month we in? July, and I noticing like this pandemic really hit people so hard. Like my debts keep increasing. My customers keep calling me and telling me, all right, mom, I can't pay you back. This might be for a while until I get back some money. So I have to now think to still survive in my business. So I have to increase my provision. I have to ensure that in case another customer comes and call and tell me that they can't pay me, I have to put some measures in place. So I'm going to increase my provision for bad debts. So all those who calling, I put in aside my money just in case for them, in case they can't pay, that is. So because I'm increasing my provision for bad debts, I'm going to debit my profit and loss account. I'm going to credit the provision for bad debts. And you see this little thing, this little note that I put here for you guys? We are going to find the difference between the old provision, which will be the trial balance, and the new provision. That simply means when I'm looking at my question and I see a trial balance and I see a provision for bad debts, and in the additional information, the business is going through some hard times, and they say, you know what? Yes, we prepared the trial balance already, but you know what? We're going to increase the provision for bad debts because so far it's not looking too good. It's not looking too wholesome to feel that we're going to get these money from our customers. So we're going to increase our provision for bad debts. And when we are placing it in a balance sheet, so please note, bad debts is only in the profit and loss account. The provision for bad debts will be recorded in the balance sheet. When we're dealing with debtors, we're going to less our provision for bad debts with the difference between the trial balance and what you see in the additional information. All right. And then another scenario could come, which we all aim for this last one. Everybody will aim for this. A decrease in the provision for bad debts. Think of the common sense. Look at the common sense answer here, you guys. We know a bad debt is when a customer owing us money, right? If a customer says, hey, I get some money, I find some money, I could come and pay you back. That's what every business owner wants to hear. So we ready to say, yeah, come true. We want the money. What we're gonna do is that we know we get any money, so that's definitely going to decrease what they owe to us. The money that they're owing to us will be decreased. It will also add to our gross profit in the business because, hey, we're getting some money. So we're going to flip this around. We're going to do the opposite. We're going to debit the provision for bad debts and credit profit and loss account. This here, crediting a profit and loss account will be our increase in our revenue. We are basically getting back the money from our debtors who would have previously owed the business money. And as a result, because we are getting it back from them, I can add more money into the business. My provision for bad debts could decrease. My losses could decrease. My profits can definitely increase. All right. So that's a good way to remember, once you're decreasing our provision for bad debts, we are going to add it to our gross profit. But if we have to increase it, we just have to know how to account for it. Again, accounting for it is the same way, but placing it in the statements will be different. So yes, we find a difference between the old and the new. Where we're going to place it is what will tell us if it's increase or decrease. All right. So that's just a half of what we just spoke of. So you all should know, well, I know you all will not know this, but when I am teaching a topic, any topic in accounts, I usually spend around 3 weeks to complete that topic. So far, we are accounting for adjustments. We look at basic part of income statement and balance sheet, and now we are looking at the adjustments. And next week, we will add to the adjustments, do a question, and balance it off. So we have a question here with what we just spoke of. And this is taken from the Frank Word textbook. And I don't think I would have made mention to you guys, or I think I would have made mention to the recommended textbook for PoA, the CSEC Principles of Accounts by Frank Word and Sheila. That is the textbook, whether it be 4th edition, 5th edition, 6th edition. If they have a 7th edition, please make this your duty during the summertime to purchase that textbook. I'm urging you guys to do that. That is the main textbook that is going to prepare you all to get those distinctions in the exam. All right, as well as when we practice our past papers, etc. And obviously attendance, yes, attendance in the class. So we're going to see a question here now that I'm going to walk you through. I'm going to walk you through it, but I'm not going to do it in this session. I'm going to do it in our next session. All right. So, what's going on? Right. So this question, let me just now, you guys, it's just going to pause for a while. Going to see if I can get it a little bit bigger. Hold on up. I'm just bringing it back up on the screen so you all will be able to see it. Great. So we have here the textbook question, CSEC Principles of Accounts for the Caribbean. This is taken, if you all want, if you all have it, you could actually go into the text. You all, I don't know what's going on with my screen here. Just give me a second. I have so much things open. So I'm just going to share it again. If you all are not seeing it. So it's lesson 2. So by the time as I'm trying to open the screen here, it's in the 5th edition on page 291. And the 6th edition, for those who are using 6th edition, is 28.11x. I'm gonna just show you all the question here now. For those who don't have the textbook as yet. 26.11x in the 5th edition, 28.11x in the 6th edition. This is taken from the CSEC Principles of Accounts by Frank Wood. 5th edition, 28.11x, and the 6th edition, 28.11x. So we have a trial balance. I'm just going to walk you all through this question. So I'm sure it is already looking very familiar what we just did, right? By the way, the question we just did was actually a past paper, a very simple one, right? So we're advancing here. We see in the same trial balance, not the same, but similar. And we are seeing some additional information. We have stock of outside the trial balance. So we should already know that this stock is dealing with our closing stock. Expenses owing, sundry expenses, $62, motor expenses, $33. Owing, accruals, we added to our expense. So when we're looking at the sundry expenses, which I'm trying to locate here, 807, we know that in the profit and loss section, we are taking 807 and we are adding it to the 62. So 807 plus the 62 will be our sundry expenses. And with motor expenses, where are you? 4917 in the trial balance and accruals is $33. Then we need to know that we have to add that $33 to our motor expense. All right. Prepayments. We had just one prepayment, which is rates. Rates in this question here is, where is rates? Right. Rates, 16,184. Sorry, 20. Sorry, rates and insurance. I was looking at it wrong. Rates and insurance is $28.96. But the prepayment is saying rates $166. So we know that there was a prepayment, $166. So we need to minus this from our rates account to get our actual figure for rates. Should be around 2730. You're minusing that. Provision for doubtful debts, 580. So they didn't, oh, actually they said it's to be reduced to 580. So remember I was telling you earlier just now, debtors come in to pay off their debts. Make them come and pay off their debt. It's going to add to our gross profit. So it is being added to our gross profit, which is, so it's reducing to 580. So what that means is how much did it reduce by? So we're seeing here provision for doubtful debts being 658. Where my cursor is. All right, it was originally this, but it's being reduced. What I tell you guys, you find the difference between the old and the new. What is the difference between 658 and 580? That should be about $78. $78 is going to be added to our gross profit figure. Depreciation. Well, simply they just said depreciation of motor van is $2,100. We have no calculations to do. So we just place our depreciation figure in our profit and loss section. Part F is saying part of the premises to be lent to a tenant who owed $250. Right? So that basically, you guys will speak to us about the premises to be lent to a tenant who owed $250. We could keep that out for a while, but I want us to look at G because I know class is going to finish in a bit. Loan interest owing to P. Holland. Loan interest. Interest is the expense. Loan is our liability. Interest, expense, you hear the word expense, it goes to the profit and loss account, right? And the loan obviously will go into our long-term liabilities. So we go back to just F there for that 250. Part of the premises to be lent to a tenant who owed $250. That's something like a little income owing, huh? That's income owing. Part of the premises was lent away to the tenant. This tenant is owing the business, owing income, income owing. Income owing, if you all go back to the recording, you will see income owing is a current asset. So hence you will put it under your current asset section. So I'm going to leave you guys with this at-home question to do. This is again from the textbook. When we start our new term in September, you all will be looking at the past papers. I'm not doing past papers during these YouTube videos. You all will be able to get a hands-on approach when we start in September with these past papers. But for now, expect the past papers to look just like this. You are not losing out. You all are definitely going to be seeing past paper questions resembling what you all are seeing right now on this screen. All right, so that is going to be it for class for tonight. I hope you all were able to understand now the adjustments of the financial statements. We still have a lot more to do, but next week, please God, we will be continuing with the same topic as well as whatever additional questions you all may have. Please make every attempt to it, and I will see you guys next week, please God. Have a good week, you guys. Bye. For those who are in my class tomorrow, it's POB. So I'll see you guys then. Bye.